You may be wondering, how does a $112.5 million investment reshape a city's commercial landscape? Welcome to the Commercial Real Estate Insights podcast. I'm your host, Steve Hamoen. Let's get right to it. The Liberty Park project in Memphis is advancing with significant new additions, according to a report by Omar Yusuf from the Memphis Business Journal. This project, valued at $112.5 million, is set to include a Hampton Inn by Hilton, featuring a 5,000 square foot restaurant space on the ground floor. Alongside the hotel, the development will also boast apartments and retail spaces, making it a multifaceted hub of activity and commerce. This development is part of a broader vision for growth within the Liberty Park area, which has been a focal point for private developers seeking incentives for further expansion. The project's multifamily housing and retail components are expected to draw new residents and businesses, contributing to the economic vibrancy of the area. For our listeners in the Kitchener-Waterloo and London, Ontario regions, such developments may sound familiar. These areas have seen similar mixed-use projects that integrate residential, retail, and hospitality elements, aiming to create vibrant community spaces. The Liberty Park project is a testament to how such developments can be a catalyst for economic growth and urban renewal, a concept not unfamiliar to those in Ontario. In an American context, this project aligns with a growing trend in urban development, where cities are increasingly investing in mixed-use spaces to attract both residents and businesses. Such initiatives are reflective of a broader movement towards creating live work-play environments that cater to diverse community needs. EDENS has recently expanded its portfolio in South Florida with the acquisition of the Weston Road Shopping Center, a 108,623 square foot open-air shopping center located in Davie, Florida. This property was acquired for approximately $51.3 million, which breaks down to about $483 per square foot, according to a report by Commercial Observer. The previous owner of the asset was Barings, the real estate division of MassMutual, as noted by Commercial Edge. The Weston Road Shopping Center, completed in 1999, is strategically located east of Interstate 75 at 4410 to 4484 Weston Road, near Griffin Road. It spans 14.1 acres and benefits from a daily traffic flow of about 33,000 vehicles. However, the center recently lost its anchor tenant, Office Depot, which vacated the space earlier this month. Current tenants include well-known brands such as Verizon, T-Mobile, Smoothie King, Weston Diner, Mission BBQ, Jersey Mike's Subs, Dunkin', Spartan Gyros, and Pizza Heaven, among others, as reported by Commercial Edge. With this acquisition, EDENS now owns 12 retail real estate assets in the greater Miami area, including prominent locations like River Market in Fort Lauderdale, Shadowwood Square, and Lakeside Center in Boca Raton, and Fifth and Alton in Miami Beach. Just last month, EDENS completed enhancements to the downtown Palm Beach Gardens property, adding 13 new or expanding retail partners. These new tenants offer a diverse mix of fashion boutiques, eateries, personal services, and wellness and spa offerings. EDENS' portfolio consists of more than 100 open-air retail centers and mixed-use projects across high-growth markets in the United States. In a notable transaction last September, the company sold a 158,709 square foot grocery-anchored shopping center in East Greenwich, Rhode Island, to a joint venture between Regency Centers Corporation and Brand Street Properties for $46.7 million. This property, covering 20 acres, originally came online in 1990. Centennial Yards, an ambitious development project in downtown Atlanta, is gaining significant traction with the addition of major tenants such as Cosm and Live Nation Entertainment. This 8-acre entertainment district, situated in the area known as the Gulch, is positioned to become a vibrant hub of activity, drawing in both locals and tourists alike. The project has been in the works for several years, but recent lease agreements are accelerating its momentum, according to a report by Amy Wenk from the Atlanta Business Chronicle. Cosm, known for its immersive technology experiences, and Live Nation, a leader in live entertainment, are expected to bring a dynamic mix of attractions to Centennial Yards. These leases mark a significant milestone in the development of the district, which aims to integrate retail, entertainment, and hospitality spaces into a cohesive urban environment. The involvement of such high-profile tenants underscores the potential of Centennial Yards to transform the downtown Atlanta landscape. The Centennial Yards project reflects a broader trend seen across North American cities, where developers are focusing on creating mixed-use environments that cater to a wide range of community needs. This aligns with the growing demand for spaces where people can live, work, and play in close proximity. Such developments are becoming increasingly popular in urban centers as they promote economic growth and enhance the quality of life for residents. For our listeners in Kitchener-Waterloo and London, Ontario, the concept of integrating entertainment, retail, and residential spaces may resonate with local projects that aim to revitalize urban areas. These Canadian cities have seen similar investments in mixed-use developments that seek to create vibrant, interconnected community spaces. The Centennial Yards initiative in Atlanta serves as a compelling example of how strategic leasing and planning can drive urban renewal and attract significant commercial interest. Blackstone, a major player in the investment sector, has announced a strategic move by merging 3 of its portfolio companies to form a new real estate entity known as Perform Properties. This merger involves Shopcore Properties, Retail Opportunity Investments Corporation, and EQ Office, creating a portfolio that spans 33 million square feet across 175 properties in 36 markets. The newly formed company will be led by Alex Vouvalides, who previously managed Shopcore and EQ Office. According to CoStar, the Perform Properties portfolio includes 155 retail locations and 20 office properties. Notable assets within this portfolio include Chicago's Willis Tower and the Charles Schwab Building at 211 Main Street in San Francisco. This move comes as part of Blackstone's broader strategy to create a diversified real estate operating platform that excels in both retail and office sectors. As part of this merger, the addition of Retail Opportunity Investments Corporation brings 10.5 million square feet of West Coast shopping center real estate to the portfolio. This follows Blackstone's recent $4 billion acquisition of ROIC, which was formerly a public real estate investment trust. The retail portfolio now boasts 19 million square feet of open-air retail centers distributed across the United States. Blackstone has also been actively investing in industrial assets, securing $800 million from Norway's sovereign wealth fund to invest in logistics sectors across the United States and Canada. In April, they agreed to pay $718 million for a 95% stake in a 6 million square foot U.S. industrial portfolio developed by Crow Holdings. This merger and Blackstone's recent activities reflect a strategic focus on creating value through diversification and scale. The formation of Perform Properties is particularly noteworthy as it combines the strengths of its retail and office assets to better serve tenants, customers, and investors. Despite market uncertainties and shifts in global trade policies, Blackstone continues to attract significant capital, with $62 billion in capital inflows in the first quarter alone, highlighting investor confidence in its approach. As we wrap up today's episode, let's delve into a critical discussion surrounding the future of commercial real estate. According to a recent report by Altus Group Limited, commercial real estate investment in Canada has witnessed a significant decline. From the first quarter of 2023 to the first quarter of 2025, investment sales volume fell from $12.3 billion to $8.5 billion, marking a 31% drop. This decline in investment sales volume, which reflects transactions of income-producing assets in the commercial and multifamily real estate sectors, has been attributed to several factors. Robert Santilli, the Valuation Advisory Director at Altus, points to a mismatch between buyer and seller expectations as a primary reason. The gap between what buyers are willing to pay and what sellers are asking for has widened, creating a bid-ask spread that has contributed to the slowdown. Another significant factor is the increased cost of capital and mortgage debt for both institutional and private buyers. With the rise in interest rates during 2022 and 2023, the financial landscape has shifted, making it more challenging for buyers to secure funding. Additionally, there has been a slowdown in the fundamentals of certain asset classes, such as industrial properties, further impacting the investment climate. Interestingly, The basic nature of commercial real estate may be evolving. Traditionally, commercial real estate, especially office spaces, were seen as secure investments, akin to government bonds. Dror Peleg, author of Rethinking Real Estate, notes that these assets were once backed by long-term leases from large corporations, providing a stable income stream. However, the dynamics are changing as leases become shorter and vacancy rates increase. Peleg suggests that successful buildings today offer more amenities and services, transforming them into entities that operate more like businesses rather than simple rent collection ventures. This shift indicates a broader trend towards creating spaces that offer value beyond just physical infrastructure. Despite these challenges, some experts remain optimistic about the future of commercial real estate. Andrei Pavlov, a finance professor at Simon Fraser University, believes that commercial real estate will continue to be a safe haven for investors. He highlights its ability to hedge against inflation, offering a level of security that might surpass typical corporate equity investments. Pavlov argues that even amid economic policy uncertainties, commercial real estate should deliver consistent returns. He compares the current environment to past economic upheavals like the internet boom, the 2008 financial crisis, and the global pandemic, suggesting that the risks today are not necessarily greater than those periods. As we consider these insights, it's clear that the commercial real estate landscape is undergoing significant changes. Investors must navigate these shifts with a keen understanding of market dynamics and evolving tenant needs. This episode underscores the importance of staying informed and adaptable in the face of change. Thank you for listening to the Commercial Real Estate Insights podcast. I'm your host, Steve Hamoen. See you on the next one.